We're going to get to what you're seeing in the market, which you call some bullish signals. But first, I want to talk to you about this potential reversal for the S&P. It would be historic. Right now, the S&P down about 1.5% for the month. I think the real question is, do you think that we're on track for something like that? What you've seen from earnings season so far, does that set us up for more upside in the S&P in these next few days?
Yeah, as you mentioned, my friend Scott Brown there talked about this. It could be the second largest intra-month reversal ever. Now, listen, we only have a couple more days this month. Maybe we don't quite get there, but to answer your question, we think that was a washout. We think that was a significant washout. The upside is happening, and we can get into some of the weeds of it here, but we do think there's some more upside here. And honestly, Frank, we think the lows of the year are in, and I know, you can't make that for sure call, but we can get into it. Some of the signals we saw last week, along with this huge monthly reversal with all this negative sentiment, like you just talked about before it came on, look at Europe. Look at some of the other parts of the world. I mean, like Germany's almost at an all-time high as we do this. To me, that's hard to think this is some global calamity when one of the most important stock markets in the world is flirting with an all-time high. We think the U.S. probably plays catch-up the rest of this year, and we think lows might be in.
All right, think those might be in. You're also seeing some very bullish market signals. We're going to show the audience the two things that you're really focused on. One of them is called the Zweig breadth thrust, so I'm going to have you explain that one. The other one is something that we all can see very clearly ourselves. Last week, the S&P had 3 days up 1.5%. So according to your research, after the S&P is up 1.5% in 3 consecutive days, on average, the S&P gains 22% over the next 12 months, 100% of the time. So it has some very clear history of a positive trend. Do you think we're set up for the same thing this time around? And keep in mind, over these next 12 months, we have the end of the tariff pause potentially, and we have some other trade policy that could come up. A lot of outliers potentially that might change that historical precedent.
Yeah, you're not kidding. And also, we're getting closer to the midterm election year. Right. Midterm years usually aren't that great. But listen, we do think the significant upside is here. We've been overweight equities all year. We have dialed that back a little bit going into Europe, going into some low volatility, some other areas. But we think, stock's still going to do pretty darn good with what you just said. And like you said, the listeners understand 3 days in a row, up 1.5%. That's a buying thrust. And like you just said, higher a year later, 10 out of 10 times. It is what it is. But the other one's that Zweig breadth thrust. I know a lot of people on social media talk about this over the weekend. 19 out of 19 times, Frank, we've had a Zweig breadth thrust. The stock market's higher a year later since World War II. What in the world is it? I'll keep it real simple. Looks at advanced declines on the NYSE. What we're looking for in this is extremely oversold. And then within a 2-week period, you go from extremely oversold to extremely overbought. That sound familiar? That's what we just did. And it triggered on Thursday. And like I just said, 6 months later, never lower. A year later, never lower. Higher 19 out of 19 times, up I think like 22 or 23% on average a year later. These are just little clues. But any one of these by themselves, no. You just take a grain of salt. When you stack these on top of each other, one more just to add to the fun and the numbers on a Monday morning. 3 days in a row last week, we had 70% of all the stocks in an NYSE higher. So everything was higher also. 1 year after that, S&P's higher 26 out of 27 times with up around a 20% average return. So when you stack these on top of each other with the earnings season, with the negative sentiment, yeah, Frank, we think, I know the headlines are the headlines. Last comment here. We're still pretty optimistic.
Before we get to the last comment, I want to ask you about one other thing. So you're seeing the bullish signals, but you're also giving me some mixed signals, because you told us you really like the Invesco S&P Low Volatility ETF. We're going to show it. It's actually underperforming the S&P since the tariffs were announced, if you go back to April 3rd. So you like a low volatility ETF, but you think we're set up for a bullish run. So why would I put my money in a low volatility ETF if we're set up for a bullish run? And why would I invest in this one if it's underperforming the market while it's been volatile? Isn't that the whole point of a low volatility ETF, is that when we see volatile times that it's going to outperform?
No, you're right there. Now, the way we've used it is as a barbell. So to get real in the weeds of the models we run for our Carson partners, we've done some momentum barbelled along with low volatility, and that's maybe 15 to 20% of our portfolio. That barbell trades worked really well. So if the upside comes, momentum's going to do a lot better. But again, we've got international exposure, we've got U.S. exposure. I mean, we're still overweight equities. We're ballpark 74-75% equities in our unconstrained models. We can do whatever we want. We were 90% this time when you and I were talking a year ago. So we've dialed that back with some other areas. But overall, we still think U.S. plays catch up here.